Welcome back. Banks are definitely the flavor of the moment. So we invited City Union Bank on our show. The lender reported its best return ratios in 19 quarters, aided by the net interest margin improving to a 7-quarter high. Loan growth remains a little weaker though. To discuss the quarter gone by, we are now joined by N. Kamakodi, who's the MD and CEO of City Union Bank. Mr. Kamakodi, thanks a lot for joining in. First I want to talk about the weaker segment, right? Because loan growth is below your own average and below what your peers are doing as well. Can you tell us what is the outlook on loan growth? Why are you not growing at such a fast pace? And what's the average that you could do by the end of the year?
You may remember somewhere around November 2019, even before the COVID, we declared that the things were not conducive for growth, and that's why we were taking our pedals off the growth. Then we had the issues of COVID and all. And even when we were declaring our fourth quarter results, we said things were not pretty okay, and we were not comfortable in looking into the growth aspects. But along with our first quarter results, we said we will be growing between 15 to 18% for the current financial year, and it will be towards the end of the current year. So we are sticking with these expectations. We feel we have, after many years, we have now started slowly pushing the pedal, for which we have started changing the internal processes and things like that. So we expect we should be, if everything goes well as they are now expecting that there won't be any further bad impact because of the Ukraine war or oil price or inflation or rate hikes and things like that. On as-is varies condition, we expect we should be closing the current financial year with the 15 to 18% growth rate in advances. And bulk of that will be visible towards the end of the current year, as we have just started pushing the growth pedal.
So what about our net interest margins? Can your net interest margin sustain at the current levels? Because banks have started increasing the deposit rates, so that should start putting pressure on your margins, right? What's the outlook?
Next, almost 3 quarters or so, the numbers should be almost similar to whatever we have, plus or minus 10 basis point. Normally, whenever you get into the increasing interest rate environment, since your loan book is in floating rate, the rates passed on immediately, and term deposits typically take about 1 year to get repriced. So keeping that logic in mind, the current level of margin should be, holding good for maybe next not less than 3 quarters or so. Almost for the last 3-4 quarters, the incremental, NIM is not more than 10 basis point or so. We are in the same bracket for quite some time now.
So you're saying you expect this to hold as well for the coming few quarters, around 4%?
Yeah, we have been touching the 4% between, say, 3.9 to 4.1 for the last almost 7-8 quarters now.
Okay, and Mr. Kamakodi, you were saying that, you will look to grow at 15 to 18% for the coming year. Can you tell us what segments are likely to drive this growth?
As you might have observed, our core focus is, MSME, agriculture and commercial trading. And when we said we did not want to grow much, bulk of our growth rate came from the agri gold loan. So going forward, the entire growth rate will be coming under these 4 segments. Incrementally, once the regular MSME core advances start growing, the proportion of the gold loan will get plateaued.
Okay. In terms of your slippages, what is the expectation over, the next few quarters? What would the run rate be per quarter? And also, in your restructured book, can you tell us how much of the restructured book could turn bad? Because some of the sectors that you cater to, right, MSME in the rural areas has not recovered as well as perhaps what one would have expected.
See, we had about, 2 to 2.5% slippage to the closing advances for the financial year 17, financial year 18, and financial year 19 pre-COVID. From the fourth quarter, after the arrival of the COVID, for 2-3 years, we had our slippage ratio increasing to about 3 to 3.5%. And things have now started moderating back to 2 to 2.5%, which is the pre-COVID level. More than the slippage, we had issues with the recovery because the courts were not functioning during the COVID period. But now things have started coming back to the normalcy. the gap between the slippage and the gap between the recovery has started almost balancing. The gap is not more than 30-35 crores currently, which is one of the important reasons for our increased, let's say, reduction in the credit cost or decrease in the gross and net NPA. And we are sure that the slippage ratio are already, they will be stable around the pre-COVID level. And when I say this, it includes the slippages from the, let's say your restructured book or other core advances or ECL book. All put together, things will be, we have already reached the pre-COVID level, and we are reasonably confident that, let's say, this should be stable for years to come.
So this quarter, slippages of 261 odd crore, where did it come from?
It's covered across the sectors almost in proportion to the our exposure in the core book. There is nothing, like say, specific to one particular segment or sort of skewed. Like it's across the segments.
Okay, that is on the slippages. You know what looks very good for you this time are the return ratios. So the ROA is at 1.72. You have the ROE at almost 16%. Do you think this is something that can hold?
Yeah, we had, like say, consistent track record of, like say, pre-financial year 20 till the third quarter of financial year 19-20. We always had our return on assets above 1.5% plus. On financial year 19-20, we said after the arrival of the COVID, we drew the line at ROA of 1% and reversed everything back to the provision, expecting, like say, if at all anything bad happens because of the COVID. Now everything is, like say, cleared and things have come back to the normalcy. We trust we should be getting back to our pre-COVID level ROA, which we have already gone. In fact, during the middle of the pandemic, when you asked, we said we should be getting back to the pre-COVID level ROA of 1.5% in the second half of financial year 22-23. In fact, that has happened in the first half itself. Ahead of whatever we expected. We hope the current level of ROA should be sustainable going forward.
Okay, on that note, we will let you go. Mr. Kamakodi, thanks a lot for joining in and speaking to CNBC TV 18. Thanks for being with us on the channel. That's the word coming in from City Union Bank. Let's see.